strategy wherein industrial, or for that matter, heavy capex industries will also be included. Oh, the quality, they have to fulfill the quality parameter. So all those infrastructure, heavy engineering industries company which fulfill the quality parameters will now form part of our investable universe, because going forward, as India is rebuilding, I think these companies have great potential. And government has also has evolved this process, what you call as EGOM, wherein government has transparently brings out an auction, and a transparent payment mechanism is there. So if companies do that, complete their work, they get their payment online, hassle free from the government. So I think this has reduced the working capital cycle of capital goods heavy industries, and they have become far more better. So there are these two changes that we are making in our Hexa framework. And the last 1.5 2 months that you see on the right side, the quality index has outperformed because of those certain two sectors. Those sectors have outperformed, and we have incorporated this in our Hexa framework. So rest be assured, you will have one of the best quality portfolio going forward, which aligns with India's story, and has got great fundamental attributes going forward, which Nirali will explain in a while. So now a quick recap. What do we mean by quality? High quality company which passes the 6 Hexa test that I have already said. They should have high return on capital, high return ratios, and basically our earlier strategy was 65-35 global. So now, given that RBI restrictions are still in place, now we are retuning, and this is also one more announcement that we are making. We are retuning our entire portfolio to India only, or domestic portfolio, and created 25 companies, India centric, high quality growth companies for our investors going forward. So basically, this ultimately it's the portfolio that will drive the returns. And going forward, how this portfolio can deliver that kind of return. So my fund manager, Mrs. Nirali Bansali, will deep dive into the constituents of portfolio, the sectors wherein we are overweight with. I think you have got the latest fact sheet. There is a whole lot of change in our in terms of portfolio, the constituents. So let me repeat to sum up what the changes are in our strategy. So we have retuned to India only strategy, include capital intensive and PSUs as part of our investable universe. Tweaking, we have tweaked our weights. Our beginning weight will now be 3 and 4%, and let our profits run, let our winners run, and cut our losers. We will have little high churn in this strategy. So these are the four changes, principal changes we have made in our Hexa framework. So now I think this is where the new portfolio is very high quality. Once you see the fundamental attributes, you all will come to know. So now, without taking much time, I will hand over to Mrs. Nirali Bansali for to deep dive into portfolio and its constituents.
Thank you, everyone, firstly, for joining us today. So today I will take you all through, now that you all are aware with what our strategy is, I will take you all through our portfolio insights, as in I will explain the constituents that we have and the reason, the rationale behind them, our positioning from a sectoral perspective, our liquidity, our active share, etc. So I'll just give you all a brief as to why we are positioned in a certain way at this current point in time. Let's first begin with our portfolio. So the FlexiCap fund currently has 26 stocks and very minimal cash that we hold. As you all can see, markets are making higher highs every day, maybe barring today, but whatever, higher highs every day. There is definitely a need to be invested in the markets. That's what our belief is. And therefore, we are almost completely invested in the equity markets with our fund and hold minimal cash. From a market cap perspective, yes, it's a truly flexi cap fund. We have large cap quality companies in our portfolio. We have mid cap quality companies, which is around 41%. Large cap is around 24%, and small cap is around 33%. So that way, we have constructed our portfolio, and at a later point in time, as the dynamics of the market keep changing, we will definitely look into this aspect and make changes accordingly. From a sectoral perspective, our highest weight currently is towards capital markets, which is around 17%. But having said that, industrial products, aerospace, and defense, automobiles, non-ferrous metals, consumer durables, all these also make a very significantly large portion of the portfolio. But be rest assured, it is a truly diversified portfolio, and there is no concentration in any one particular sector. So this is our sectoral positioning, as in the industry positioning that we have in terms of our exposure. From an active share perspective, yes, we are still truly active. Our active share currently is around 94.96%. So our top 10 constituents in the fund compared to the benchmark are very, very different, and therefore our active share continues to remain very high. From a liquidity standpoint, again, there is no hassle at all. We own very highly liquid stocks, irrespective of the market cap. As you can see, 99.74% of our portfolio can be liquidated in a single day. So there is no question of having illiquid stocks in this portfolio. Coming to our fundamentals, so yes, we are really focused on quality, earnings growth, high return on capital employed, high ROE, and good margin kind of a business. And therefore, if you see the portfolio constituents, you will see that there are only quality names in our portfolio. So let me give you a sneak peek into some of the fundamentals of our businesses on a consolidated perspective. So these 26 stocks that we have on a consolidated level, you'll see our ROE is around 25%, our ROC is around 30-31%. If you see our operating margins of the businesses that we hold, it's around 29%. The businesses that we hold are not very highly leveraged, and therefore the debt to equity is also very, very minimal at 0.15. Even in terms of a valuation, we are almost fairly valued at around 51 times price to equity. So from an overall quality fundamental perspective, there is no compromise at all. And all the businesses that we own are definitely in the quality, in the high growth bucket of their own business cycle. So basically, these are growing businesses in the business cycle that the particular business is present in. And let me also tell you from a sectoral positioning aspect why we are bullish on some of these themes, or why we hold the certain exposure that we have currently in the portfolio. So there will be around 6 themes that I will explain in terms of various businesses or the companies that we hold and why we like these stocks. So capital markets, as you all are aware, India is in a growth trajectory. So Indian equity markets are definitely growing very, very fast. And as we speak, the need of the hour is definitely to be present in capital markets. Indians are increasing their savings rate day by day. So our savings, Indian savings, are growing by around 8% CAGR from FY20 to FY23. And as this saving increases, what happens is the whole asset ownership pie also increases. And our investments in equities, in debentures, which is around 7%. So as the pool increases, as the savings increases, this is also expected to rise. So capital markets are bound to move higher and higher from these levels. And there is another factor which is helping asset and wealth managers improve and move ahead. And that is the number of ultra HNI clients that are there in India. So if you see the ultra HNI client tailwinds are very, very strong in terms of the number of ultra HNI clients. And this number is also fast growing. So all these aspects make India a very promising, attractive destination in terms of investment, and especially in the Indian equity markets. As you all can see, mutual funds are also, that is also a space which is a part of the capital market. So mutual fund industry is a growing industry, almost 20% odd. It's crossed 61 lakh crore in terms of AUM, but the penetration is still very, very low. So it's around 14% for India, which is much lesser than the global average. So there is only around 3% of India's population which actually invests in Indian mutual funds. So therefore, there is a need of the hour is to be associated with these kind of businesses and invest in these businesses, especially at the current level. So by way of having exposure to capital markets, we have an HDFC AMC, we have Nippon Asset. HDFC AMC, I'm sure, needs no introduction. The brand and the intangible moat that it has built for itself in by way of providing very strong customer service, or the trust that they have built, have enabled sticky money, and the retention ratio over there is very, very high. So they have already reached 16 million active accounts, and the growth that they see is upwards of 40% in terms of opening new accounts. So HDFC AMC is definitely a very attractive opportunity that we see. In terms of Nippon Asset, yes, Nippon Asset is in fact one of the fourth largest AMC in terms of their QA AUM, and it's almost over 4 lakh crore of their QA AUM that they have, plus a 40% plus growth on a YOY basis. And in terms of their market share, the incremental growth that they've seen in the market share is the highest among all other AMCs at the current moment. So all these factors make NAM India also very attractive, and the equity exposure that they have is quite stable, consistent at almost 49%, and that has also enabled them to improve the margins of the business. So these are some of the reasons why we like the stocks that we hold in the portfolio. We also have exposure to a Motilal Oswal. Now, this company is also not far behind. Yes, even in their wealth and private client group AUM, that has also grown around 70%. Plus, they get a lot of revenue from brokerage income, which is also fast rising as you know the ADTO in India rises. So all these factors have enabled them to deliver double-digit growth, and the expectation is going forward as well. They could deliver around 15-20% on a PAT basis, and their operational ROE is also quite consistent over 20%. So this is also why Motilal Oswal is one of the businesses that we hold in our portfolio. 361 WAM is also a part, and it is a very, very strong player in the asset and wealth management space. It was known as IIFL Wealth Management. And what the 361 WAM does is their risk management and investment management tools are very strong, and because of that they have been able to garner an average ARR AUM of almost around, so current book is around 2 lakh crore, and that has also grown by 38%, and the total revenue is also up by around 61% on a YOY basis. So this has been possible. Why? Because 73% of the families have been associated with 361 WAM for a period of 5+ years. And this association, which extends beyond 5 years, in fact, that has enabled a rise of 2.4 times in the average AUM per family. So the 361 WAM has definitely built a moat around itself, and because of that, because of the kind of service they have, because of the kind of returns that they enable investors to generate, you can see that the company is really doing well. So therefore, we are very, very bullish on capital markets as a theme, and we have a good exposure, a significant exposure in that sector. Coming to industrial products, by way of wires and cables, we have exposure to this space. Why wires and cables? Because we expect a very strong demand going forward in this particular sector. And the volumes are also expected to rise, because as the GDP per capita rises, the per capita usage of wires also increases. And wires and cables actually have a lot of use cases, in terms of how they benefit or service the consumer or any other business. So the application is in housing, the application is in power, the application is in data centers, railways, you name it, and you need a wire and a cable in that particular industry or a sector. And there is a very, very huge push by our government to increase the capacity in the power sector. So there is an expectation of at least a 15 to 17% growth in wires and cables demand in the next few years. India has already become a net exporter in this space, and it is almost 1.5 times more than the import value. So there is good demand and good tailwinds, especially in wires and cables. And yes, data centers is a very new emerging space where also the demand will be required or will be met going forward. In fact, IDC forecasts the data volume to grow at 27% CAGR going forward. So this is the kind of growth that we see from industrial products, and KEI Havels therefore are a part of our portfolio. Coming to aerospace and defense, this doesn't need a lot of introduction because it has been the talk of the town. But just by way of how we think, let me give you a very small picture. The government definitely has a lot of policies which are pro-defense and India manufacturing of defense products. So the indigenization lists that come out, they have manufacturing targets of around $21 billion just by FY25, almost a $4 billion target for exports, defense exports from our country. The expenditure that they have in of the GDP in terms of defense from a 3 lakh crore has jumped to 6 lakh crore only in a very short span of time. So all of these factors, plus the fact that defense is definitely a part which the government wants to build, especially basically the government wants India to be a part of the global defense footprint. So this also is a very big factor which is enabling and pushing defense stocks currently. So we are a part of the story by way of Hal and Bell. Basically, Hindustan Aeronautics accounts for 40% of India's capital spends on aircraft and aero engines, and this is expected to rise to 51%. Their order book is already very strong, almost a $1.2 trillion order book is expected by FY25, and the pipeline going forward is also quite strong at almost 1.6, 1.7 trillion rupees. So from an order perspective, there is no problem. Growth is also very strong in terms of order flow, 50-55%. So we feel that going forward as well, there is a huge runway of growth which is left for Hindustan Aeronautics, even from the current levels. Coming to Bharat Electronics, a similar situation, order book is very strong from 77,000 crores expected to cross 90,000 crores in just a span of 1-2 years. And in terms of their ROE, yes, it is very strong, around 20% and plus. In terms of their revenues, they are double digit. In terms of their margins, they are very strong. So we expect this runway of growth to continue because there is a lot of push that is happening from the government side, and that we don't think is going to stop immediately because it has just started. Coming to automobiles, we do have an exposure to automobiles by way of two-wheelers. There is definitely a lot of premiumization trend which is helping two-wheelers to grow because their average sales price is growing. The costs are coming down as these particular businesses reach a certain scale. as they continue to penetrate in India, because India's penetration is very, very low at around 14.2%, whereas Indonesia, Thailand, China, much, much higher, about 30% kind of a penetration. So we do have a long runway of growth even in the automobile space. And who better to play it with other than Bajaj Auto and Hero. So both these have a very dominant market share in their respective segments. So be it the 125cc plus motorcycle segment or the 100 to 125, both have good market share. They are old players. They have been in and around for a very long time, so have built competitive moats in their business. And we feel that going forward as well, because they are getting into newer energy technologies and building their EV motorcycles. They are getting into the CNG motorcycle currently with Bajaj. So there is a lot happening, and they are not complacent about their current business. They are also moving ahead with times, and they are improving and innovating. All this will only benefit the business and enable it to grow going forward. So we are quite bullish on Bajaj Auto and Hero MotoCorp in the upcoming months. Our exposure to non-ferrous metals is also quite significant. This is because we feel that, yes, there could be a stable realization, or then the growth rate could be stable in this particular space, because input costs have seen some moderation and the realizations have been quite steady. The demand in India is quite strong, around 10%, whereas the global demand is much lower at 2%. So the demand for these non-ferrous metals will help businesses to improve and grow even from the current levels. So therefore, we have exposure to an aluminium player, to an iron ore player, to a zinc player, to a silver player, etc. Our next exposure, as in the company that we hold, is Swan Energy, which is also into various sectors and industries. That is into energy, textile, real estate. There are basically four main levers that I would like to point out for a Swan Energy. And firstly, they are in the natural gas space. So the government of India has targeted an increase of the share of natural gas in the energy mix to 15%, and currently that is at 6.7%. So this will benefit a player like Swan Energy, because it already has an FSRU which is leased to a Turkish player. So that is one growth lever that Swan Energy has. The other one is their shipbuilding industry exposure. Basically, they acquired Reliance Naval, which is one of the largest, the biggest and the highest capacity player shipbuilder in India. Reliance Naval's capacity, if you see, is 4 lakh DWT, which is much higher than a Cochin, Mazgaon, Garden Reach together. So their capacity, that capacity, once the operations begin, once the Reliance Naval gets listed, is definitely going to trickle into their cash flows and going to help Swan Energy as an overall company to, or a business to, improve. The third lever that I'd like to point out would be the LPG, the offshore, the basically LPG import facility that they have. So they have long-term contracts with other OMCs, and this is also going to benefit us, Swan Energy. The fourth lever would be the Veritas acquisition it did the last year. Now that is already yielding good returns for their business, and some of their projects actually have received an ultra mega status by the government, Maharashtra government, or actually the government basically. So therefore, there are some benefits which are aligned to or which they get, and that will be beneficial for the company to grow going forward as well. So we are quite bullish on a Swan Energy as well. Overall, with so these were some of the sectors of the industries that we are bullish on. But apart from this, we do have exposure to a consumer durable company. We have exposure to white good player. We have exposure to pharma player, to a pharma player. So yes, we have a very, very diversified approach. But having said that, there is a rationale behind investing in each of these businesses and having a certain weightage that we have assigned to a particular stock. So this was my overall brief on the exposure in terms of sectors that we have through the FlexiCap fund. Let me just summarize a couple of things in terms of the strategy and in terms of the fund that we have or the portfolio that we have made for y'all. It is an around a 25-26 stock portfolio, as we have always been communicating. We are always going to be in a focused kind of space. But having said that, the quality is never going to be compromised. They are always going to be efficient Hexa Shield tested companies. So the quality growth is a parameter which is the prime factor or our focus that we will never let go of. In terms of diversification, yes, it will be market cap agnostic. There will be sufficient sectoral diversification exposure that you will have. Currently, it is an India focused fund because of the various reasons our CIO has already explained. And we will also continue to hold our winners and cut our losers. So yes, this is just a summary of our FlexiCap fund. And as a parting thought, I would just like to say that it is important to hold on to these companies for a longer period of time. So be invested, and FlexiCap fund specifically is for the long haul. So it is, you should not be either too greedy or you should not be afraid. The idea with this fund is to have a good sleep at night and to be invested for the long run, so that the returns definitely keep coming as and when time flies. So that's the approach and that's the thought process by which we have constructed this portfolio. And we are very, very confident that we will be able to deliver with time. Having said that, yes, Janvi, we are open to any other questions, if at all.
Thank you so much. Thank you so much, Nirali. Thank you so much, Umesh sir. I think the presentation was quite intricate, and I'm sure all of us are very clear about the vision which we are having for the portfolio and existing portfolio as well. As Umesh sir started with informing that this portfolio is going to be wholly domestic, but still yet to like retouch to that point, I would like to ask this question to Dhaval, that Mr. PM Jain is asking that have you started investing in companies abroad to the extent of 35%?
Okay, okay. So thank you so much, PM Jain, for your question. So as you would know that, due to an industry-wide restriction on investing fresh funds in foreign equities, we took a call last month that, we'll strategically shift our approach and and we'll completely exit foreign portfolio, and we'll increase our portfolio to domestic only portfolio. You would know we had around less than 10% of our weightage, and because we were unable to increase our exposure for the required limit, that is 35%, we would have a minimal impact in our portfolio performance. So we decided to book the profit from our foreign holdings, and we relocated those funds to Indian equities. And of course, we would surely assess the possibility of 65-35, which was the original portfolio. It is India global exposure once the restriction is lifted. Thank you. I hope I answered the question.
Thank you so much, Dhaval. Yes, it was very clear. The next question is asked by Mr. Mehul Gosar, that will this change to Hexa Shield be applicable to other schemes which use Hexa Shield like strategy? Nirali, would you like to please answer this question?
Sure. Yes, sir. So the Hexashield framework is aligned for all our funds. It has been updated for all our funds, and going forward, whichever scheme is associated with the Hexashield from framework will always see or will always have the updated stocks present in it as well. So the change has already been made, and it's not an upcoming event, but as and when it is a technology. At the end of the day, a technology will need upgrades, and be it a FlexiCap fund or the other funds which are associated with the Hexashield framework will always continue to have upgrades in their model, and it will be implemented almost immediately. So yes, it has been implemented, to answer your question.
So
Thank
currently
you.
there are two funds, Tax Saver Fund and FlexiCap. These are the two funds that run on Hexa Shield framework.
Thank you so much, Umesh sir. Thank you so much, Nirali. The next question I would like to address this to Umesh sir. Mr. Mehul Gosar is asking that he thinks that we mentioned in earlier webinars that we were not willing to take bets on PSUs, but now we are. What is the reason behind it?
Since I tell you, I think governments are evolving, and the way this government has worked in terms of bringing transparency, in terms of looking at merits, and they are what that, and if that is what is driving, then we have also adapted that. Look, this government wants to really work for. Uh, they want the companies to work and not serve their interest, which we have seen earlier in the past. And therefore, I think PSU is as good as any other company in the private sector, and therefore there is no point keeping those companies out of investable universe. And therefore, all PSU companies which still pass the quality and growth test will form part of our investable universe. And there are various reforms that government has done, as I told, ecom, I think a fair and transparent process of procurement and payment system. So then every company, whether private or public, if you deliver, you will get your money. And I think money is where earlier there was a lot of time and a lot of bureaucracy used to happen, but now it's all online. You deliver and government will make immediate payment. So I think the whole environment is changing. The whole situations have been is changing, and therefore PSU or private, we are agnostic. Any companies that form part that is clears our quality test and growth test, we will invest, and therefore PSU will also form part of that universe.
So,
Thank
I'd
you.
like to add and explain something. What we have done is we have not force fitted anything in the model. What we've done is we have expanded it from the universe level. Then the Hexa framework runs as is, and after that, whatever clears all our 6 tests actually become a part of the portfolio. So that's how we have done it. We haven't force fitted like we haven't said that okay, now we'll tweak the Hexashield framework to force fit a PSU in it. That's not how it works. It was an upgradation in the true sense, and that's how we are calling it an upgraded model.
All right. Thank you so much. The next question I'd like to address to Mr. Dhaval, that considering that the market at the moment, have we hedged the portfolio?
Uh, when we talk about hedging, our scheme information document, we haven't included hedging as a part of our portfolio strategy. So no, we won't be hedging our portfolio.
If
Thank
the
you.
clients were to invest in the portfolio at this point of time, they are asking that for how long is it are they believing to stay invested in the fund for better returns?
Okay. So probably since this is a quality and growth portfolio, and as Nirali and Umesh sir explained that we had a few tweaks in our Hexashield model to be more relevant to the current future. So probably our returns, like the better returns which the client is expecting, since no strategy is foolproof or will be static. We also evolve with the current environment, and we think that going ahead in a larger time frame, which is probably 5 to 7 years, we think that the businesses which we have in our portfolio will do better going ahead. Anybody would like to add? Please feel free.
From a minimum holding standpoint, I feel that a 3 year would also be a good time frame to start with. And then obviously the more you hold, the better returns you will generate in terms of the compounding which plays out. So yes, over if you have a good long-term horizon, then a 3 year time period would be ideal.
All
3 year,
right. Thank you.
yeah.
Yeah, thank you. Thank you so much. Next question is to Umesh sir. It's asked by Mr. Srinivas Rao that what about valuation in defense space? Are we not late in investing into defense now?
See, defense as a sector is growing at upwards of 30-40%. Today, 5.5 lakh, 6 lakh crore is what the defense budget for India is. Around half of it goes for pensions and salary. and half is now available for the Indian companies to get a maximum pie, which earlier was not happening. So around 2.5-3 lakh crore is available on the table for Indian companies to capture, and currently around 1.5 lakh crore has been able, our Indian companies are able to capture. So still there is a lot of runway, and defense, I think, as a sector is going to be sort of for next 2-3 year horizon. I think defense will be a very good sweet spot in order to capture what this government is offering for the Indian companies to manufacture, make in India, etc. And still, what HAL and all these things, they have got 8 years of 6 years, 7 years, 8 years of order book. And no other companies we have seen that kind of massive order book available, all these shipyards, etc. So I think they have got a huge runway uh, to go for creating shareholders' wealth.
Also, to add to that, from our entry point, also the stocks have really gone up. So it's we have definitely benefited already from our exposure to these businesses, and we are closely monitoring them. So whenever we feel that yes, there is something, or we find a better opportunity as well. If the growth kind of becomes tepid and there is something else which is growing better, as we've already said, we will hold on to our winners, but we will cut our losers. So we are observing it, and it is already to our benefit, and that's why we continue to hold it in our portfolio currently.
And Mr. Mahesh, like following up with what we are already addressing, so Mr. Mahesh Mirpuri is asking, so will this be a buy and hold stocks for long periods, or will you be more dynamic than earlier?
So there could be a mix of both. To be honest, because if we want to let our winners run, we will hold it for a longer period of time. And if something is really not working out, because it is a 25-26 stock portfolio, we will definitely cut it faster. So yes, compared to what we have done in the past, we are going to cut it faster. We are not going to wait for a very long period of time. And in terms of our winners, we are going to hold them for a longer period of time. So there will be a mix of both, but largely it will be it is a long-term portfolio.
All right. Thank you so much. So an anonymous attendee is asking this question, and Umesh, I'd like you to take up this question, that how to differentiate this fund from multi-cap and other flexi cap, which are having maximum large cap holdings with only 25 stocks. How will you differentiate it from the focused fund?
See, first of all, I've been, as a general rule, flexi cap has got complete flexibility to move in and around in any cap. Second, this is ultimately a strategy, steady state fund, which you can name it. But once the investor know that, look, this is a quality as a strategy which I want to hold, and I want to have a peace of mind, then these are all quality names which have got, as Nirali has already explained, high return on capital, low debt, high return on equity, high return on capital, low variability, less cyclicality, more of a secular business. So uh, these are all kind quality of businesses which a certain set of investors know that they want to invest in this business. That is why we to people have said that you are comparing with NSE Midcap 150 quality index. See why we are comparing. We are we are doing a like to like comparison with a strategy comparison. So NSE has this strategy, quality strategy. We are also comparing our fund with a strategy so that people know as a strategy we are aligned with what the best which is available in the market. But when we do on a Nifty 500, which is the benchmark, and that is where we have underperformed, because quality as a strategy has underperformed. So there is nothing that we have done good or bad, but quality as a strategy has not worked well. And my previous slide that I had mentioned, that quality and value alternates, and now probably time has come for quality to outperform, and this is why we think that this portfolio will be resilient, and going forward, if markets correct, I think this will have a better chance to bounce back. And even if interest rates starts falling, quality will have a better play. But the whole bigger picture is quality as a strategy. If people are comfortable, and this is what we have communicated right across day one, this is the portfolio that you will have if you want to own. Samco Flexi Cap Fund is a quality portfolio. Flexi Cap, we will have flexibility. And Nirali has said that now we will have a little high churn. So if things are not working, sectors are not working, companies are not working, we will get out. We will reevaluate every in a short time frame, and move into companies which are growing companies. But still, the flavor will be quality. I think this is where the unique differentiating factor for Samco Flexi Cap fund compared to maybe multi cap or maybe any other flexi cap fund. So our focus is absolutely clear. We want to stick around all quality companies that are available, and the current universe of quality is around 125, 130. Within 125, all growth companies that are growing fast, we want to own. Companies that are not growing, we will cut our losers. And this is how the retuned, the new strategy, the upgraded exhaustion strategy is all about. So this will have a little churn, and that churn is, I think, going to keep us in the top quartile going forward. And the result that one can expect, obviously, long investment is for long term horizon, but next 3 4 quarters is a time frame that investors should look at. That okay, if this what they are saying, is the strategy working? So I think 3 4 quarters is a time frame that one should now look going forward, in order to assess how the upgraded Hexa model is working for the investors.
All right, sir. Thank you so much. The next question I'd invite Mr. Dhaval to address. It's there by an anonymous attendee that while the stocks are good quality, does the high PE at these levels worry? How do you intend to make the fund less volatile and better in returns?
Okay, so thank you so much for the question. So the thing is that because we have, or is this the portfolio is 25 stock odd portfolio, you would see that the mandate that we have, the mandate that we work within Samco Flexi Cap Fund is to have the best quality portfolio, as Umesh sir said, best quality portfolio with of course growth linked to it. And uh, it's it's law of the land that any quality, any growth business or portfolio or anything in the world is of is a little pricey, or you have to pay a little more than what you are normally paying for the businesses. So wherever there is a quality business, and of course, like our portfolio price to earnings ratio is 52 times. One may say that okay, 52 times is quite is quite high, the price that you are paying. But of course, when you compare it with other FMCG players or other retail businesses, we would see that okay, this is trading at a very very normalized valuation. So what we think that this is quite a subjective term. What we track at Samco Mutual Fund is that the quality should remain intact, the growth should remain intact, and because we have a mandate of 25 stock portfolio, those 25 names should be high quality, and we would never ever compromised on the quality of the business for the flexi cap fund. So of course, uh, it may optically look like the price to earnings ratio is quite high, but probably once the growth kicks in or once it comes in, the price to earnings would normalize.
So I
And
would like to just a minute.
yes, sir.
See, today our price to P multiple is around 50. See, but if one looks at a 1 year forward earnings, so it will automatically fall to around say below 40, because all these companies are growth oriented companies, and when companies are growing 1 year forward, I think the valuation will be far better. So, for example, your Voltas upwards of 100, your Honeywell upwards of 100. See, all these companies are growing rapidly, and as they deliver profits, I think the valuation will look far more reasonable. So by definition, what Dhaval has said, growth companies will have a high PE multiple, because one has to look from a 1 year, 2 year perspective. The valuation will look reasonable.
Understood, sir. And the follow-up question for it, and a lot of people have asked it. And this is also our last question: that why are we intending to keep 2% exit load on our flexi cap as compared to other flexi caps that are hardly having a percent of exit load for a year? So, what is our objective behind it?
So I think investment, our principal philosophy is what in India people have to remain invested, and 2 3 year is the minimum horizon that one needs to invest with. So I think with that philosophy, I think we have this 2% exit load, and going forward we will obviously take all feedbacks. But what we think is that this becomes a for investor, this adds a this layer of discipline, that okay, 2% exit load is that, let me remain invested for a longer period of time, but that's it. That's the only purpose we want to solve. Whether 2% does it, if 1% does it, we are good enough. But I think to make investors little, add one layer of discipline, we have kept this exit load of 2%.
Okay, sir. Okay, one last question, since it's an interesting question, and I think this question will wrap up our presentation and the objective behind it. So, Mr. Ankur Kulkarni is asking, so is FlexiCap now becoming factor-based fund with momentum as well as with quality? You would like to.
Answer is fact. So momentum is on the price side of the market, wherein we look at price, volume, volatility, speed, etc., momentum score, and then invest. But here, flexi cap is all about owning growth, quality, growth oriented companies, wherein we look at fundamentals, wherein we look at, yeah, the margins, the return on capital, debt, etc., and at the same time also look at the growth, whether the growth is sustainable. So this is how I think this all together are different. There are both different ways of looking at it. So by far, today, Samco FlexiCap will have one of the best portfolio in terms of quality, and added to it the growth flavor, and with a little bit of more churn, which earlier it was not there. So I think this is a winning combination, and India only focused strategy. I think these four pillars will do far better, and investors at least need to look at us from a 3 to 4 quarter perspective, and then assess, then judge, how this strategy works.
Yes, Dhaval, you were saying something?
No, no, no.
Nirali?
No, no. Umesh Mehta summed it really well. So.
Okay, sir. So with this, we come to an end for our presentation. Again, thank you all of the attendees who took out some time and found it important to listen to us and what exactly we have to offer when it comes to Samco FlexiCap. Thank you so much to all my lovely speakers and their presentation. It was very clear. It was a lot of clarity has been given to us for us to what to cater and how to cater to our retail clients. Thank you so much. See you all again.